Imagine this. You buy a shiny new piece of equipment for your business. Maybe it's a computer or a manufacturing machine or even high-end office furniture, and you know that you paid for it. But did you know that you might not have to spread that cost out over 5, 10, or even 30 years? In fact, thanks to some major tax law changes, you may be able to deduct the entire cost in year one. Yes, year one. Today, we're going to dive into one of those under-the-radar but powerful opportunities that we call depreciation and capitalization policies. And we're going to talk about how smart businesses are using them now that the rules have shifted. We'll explore when it makes sense to expense versus capitalize, how the safe harbor threshold works, and how the 100% bonus depreciation and expanded Section 179 deduction under the One Big Beautiful Bill gives you new advantages. If you own or manage a business and you've bought or plan to buy equipment, property, software, or other long-lived assets, you can't afford to skip this one. So let's dive right into it. The first thing I want to talk about is first off, what is this depreciation word? It can be confusing, and a lot of people run away when they hear depreciation. So let's just cover the facts of what is depreciation. And at a very basic level, depreciation is simply the process of spreading out the expense for an asset purchase over time. When you buy personal property like a car, a computer, or other types of equipment, or if you buy real property such as like a building, you have a few possible options for deducting that cost, but you got to do it right. Now, when we talk about what is items that can be depreciated, we're thinking of things like machinery, equipment, buildings, vehicles, furniture, technology, computers, all those different things that we call depreciable items. And again, depreciation is just taking the cost of purchasing that item and spreading it out over time. Now, you can only depreciate business use of items. So if you have a personal use of an item mixed in, or if you have just a personal item, of course, we're not going to depreciate anything personal. But if you have a business and personal use mixed item, you only get to deduct or take depreciation on the business use of that item. So if it's 40 or 60% business, you get 60% depreciation on that. Now, one thing to note about depreciation is that land is never depreciable. So we will never depreciate the cost of land, the land value. But buildings and land improvements on that land, those are depreciable. So let's talk about some of the depreciation options. And the main zone we're going to be talking about are regular depreciation, bonus depreciation, and Section 179 expensing. So let's talk about regular depreciation. This is sometimes called straight line depreciation, or there's a MACRS depreciation, which is often used especially for tax purposes. A couple different versions of regular depreciation, but essentially with regular depreciation, you take the cost of an asset and take depreciation, expensing of it over time. It can be anywhere from 3 to 39 years, depending on the type of asset that you're working with. So you're taking the cost of an asset you purchased and you're expensing that. You're getting the expense for that cost over the course of 3 to 39 years, again, depending on the type of assets. The next one we have is bonus depreciation. And with the One Big Beautiful Bill that passed here early in 2025, which was an incredible opportunity, they made 100% bonus depreciation permanent. Now, this is for anything bought and placed in service after January 19th of 2025. This is super powerful because it allows you to take a deduction for 100% of the cost of that asset purchase in year one, all in year one. Now, with bonus depreciation, you can use bonus depreciation to create a loss in your business. This is going to be different from Section 179 expensing, which we'll discuss next, but you can use bonus depreciation to create a loss in your business. And one other thing to note about bonus depreciation is that via the tax law, it applies automatically unless you choose to elect out. So if you're not going to use the bonus depreciation, you need to elect out of bonus depreciation. The third method that we're going to talk about from a depreciation standpoint is Section 179 expensing. And with the One Big Beautiful Bill, this also got amplified. You can use what Section 179 expensing on up to $2.5 million of assets per year. Now, one thing to note about Section 179 expensing, you cannot deduct more than business income. Basically saying you cannot create a total business loss using Section 179. So let's say you had business income of $300,000, but you have a Section 179 expense of $400. The max you could take is $300, which brings you down to zero. Now, any unused amount can be carried forward. Now, with bonus depreciation, you can create a loss. You can go below zero. Section 179, you can't. So a lot of times when we're talking about depreciation, the question comes up, which method do I use? Mike, you talked about regular depreciation, you talked about bonus depreciation, you talked about Section 179. Which one do I use? And that really depends on how much of a deduction you are looking for in this specific year. So the typical process that we would say is, number one, let's apply Section 179 expensing first, up to your business income limit. So up to the limit of your business income or the limit of Section 179. Then we can apply bonus depreciation to the remaining cost. And we can also use MACRS or regular depreciation for whatever is left over. But I think to help drive this home, I want to go through a couple use cases, because this will help us understand specific cases when we may use bonus depreciation, when we may not, when we may use 179 and not bonus in various different instances. So use case number one, let's say you have taxable income and want to maximize deductions without creating a loss in your business. For that, we're going to use Section 179. Bonus may not even be necessary. It can be used, but it may not even be necessary when we can just use Section 179. Situation number two is that you expect a loss or want to create one that you may use to offset other income. So you may be using a loss or wanting to use a loss in a business to offset income that you have in other areas of your life. Well, if you use Section 179, you're limited to it. You can only limit up to your business income. So if you wanted to max that out and create that loss, you'd have to use bonus once you've maxed out the Section 179 or brought that income down to zero, then you could use bonus. And scenario number three is that you bought a very large amount of equipment, or you're just a large business with high capital expenditures. Section 179 has a $2.5 million limitation. So if you're a very large business with a lot of spending, bonus is likely going to be the better option for you because you don't have that $2.5 million cap with bonus depreciation. Now, one cool thing is that whether you're using Section 179 or bonus depreciation, they can be used on new or used assets. Both qualify. So that's one cool feature. But another thing I want to talk about, and so many people get wrapped up in depreciation and taking it all in year one and creating all these losses. But I want to talk about a scenario that I just, at least, especially as we come to year end, I want you to be thinking about. If you have concerns about future year's income, maybe you expect a higher income later and you want to spread the deductions out rather than front load them on. Maybe this year is a low income year, but you're expecting a massive year next year, and you're saying, hey, I'm in an income year, a lower income year, I don't necessarily need all that deductions, but I'd much rather have it next year when I'm going to be in a very high income year. So different planning that you can do. You might choose to not take the full bonus depreciation this year, or you might use limit the use of Section 179, or you have basis that you're going to want to be thinking about. So we might want to choose the depreciation option based on what our tax picture is about. And don't just think about saving taxes this year. Also think about the coming years. Are you going to have massive years that you might not have depreciation for? Maybe we want to hold back instead of front loading it this year. Maybe we want to hold back when we're in a lower income tax bracket and take depreciation later on when we need it more. Or maybe we're just going to wait to buy that asset until that high income year. Everyone's situation is going to be a little different, but just make sure you're thinking about that. Running through some of those numbers of what does this do to my tax situation today? But then also, what's my tax situation next year? What's my tax situation tomorrow? And am I making a decision that makes sense for both of those situations? Now, next, what we're going to do is go through an example and some important things to consider when we're talking about depreciation. But real quick, if you are a business owner and you are tired of guessing when it comes to taxes, we just released a brand new tax savings starter kit, and it's 100% free. Inside that starter kit, you'll get our ultimate list of business deductions. You'll get our real case studies showing how we've saved other business owners $5,000 to $25,000 or more in taxes. And you'll also have access to a bonus discovery call with our team. Just head on over to taxsavingspodcast.com/starter kit. That's taxsavingspodcast.com/starter kit. All right, so let's get back to depreciation. And I want to go through an example to help kind of put this concept and this idea of depreciation into play so you understand how it works. Let's say that on February 1st, you purchased a computer for $4,500. $4,500, you purchased one computer. With regular depreciation, a computer is considered a 5-year asset. So you're going to take that $4,500 and you're going to spread out that expense and take an actual expense over 5 years. So you're not going to get a $4,500 deduction this year. You're going to take it spread out over 5 separate years. But with the bonus depreciation or with Section 179 expensing, you'd be able to take that full $4,500 computer purchase and take it as a full deduction this year. So those are the difference between the methods. Regular depreciation, we're spreading that expense out over multiple years. With bonus depreciation or Section 179, we're taking all of that deduction in this year. Let's go through another example. Let's say you buy $300,000 worth of equipment. And equipment in this situation, let's say it's 7-year equipment. And let's say you have business income of $200,000. So with regular depreciation, you're going to spread out that $300,000 equipment purchase over the course of 7 years. Now you could take 179 expensing up to your business income. So remember, you had a $300,000 cost purchase of this equipment, but you only had business income of $200,000. So if you chose to Section 179 expensing, you'd only be able to take $200,000 up into where you bring your business income to zero. The rest you would carry forward. But you could also take bonus depreciation, and you could expense the full $300,000 and then use $100,000 that would create that loss, $100,000 loss. You could use that loss to offset other income. Now, you could also do some variation of all those different strategies. So there's a lot of planning when it comes to depreciation. Again, we just need to understand, what are we looking to achieve this year? You know, if I'm generally paying tax in the 10% or maybe 24% tax bracket this year, but I know next year I'm going to be in the 37%, I might want to wait. If it's flipped, I know I'm in the 37% tax bracket this year, but I know next year it's going to be much lower. Well, let's try to beef up. Let's try to take advantage of that depreciation this year. So let's go through some depreciation rules. Rule number one is you got to be in business. There's no depreciation until your business actually begins. So you must be an operating business. You can't depreciate something that is not an operating business. Now, if you're buying equipment for a business that's not operating yet, obviously we're going to pay for that. We're going to record that. Depreciation will start once your business officially opens, once the operations actually start. But if you just buy, let's say you buy a horse farm, it's all a hobby, there's no business associated with it, there's no depreciation there. You have to have a real business in order to take depreciation. And then rule number 2 is that the asset must be placed in service in the year that you're getting depreciation. So if you wanted depreciation in year 2025, you would need to put that asset into service in year 2025. And so people say, like, Mike, obviously that makes sense. But let me give you an example that I've seen people get caught on before. Let's say that you go to Best Buy and you buy a computer on December 15th. So you buy a new computer, you pay for that computer, but then you say, oh, I need this software loaded on. So you leave it at Best Buy and they're going to load this software onto you, all these different add-ons that you specifically need for that computer. And let's say that you get that computer back on January 10th. So you purchased it on December 15th, you kept it there, they loaded all the software onto it, and then they gave you that computer on January 10th, and that's when you started to use it in your business. Well, guess what? That asset was not placed into service in the tax year. It wasn't placed into service in 2025, it was placed into service January, when you actually started using it. So that's a great example of something that you maybe paid for, but was not placed in service. So just something to think about when we're going down that route. Now, one thing that I want to talk about next is something we call a capitalization policy. And a capitalization policy is something I'm super passionate about because I think that every business owner should have a capitalization policy in place. And it ties in a lot with this idea or this thought of depreciation. Basically, a capitalization policy is a simple policy that you put into place in your business where it says that you will immediately expense any items, any asset purchases that are under $2,500. So if you purchase an asset that is under $2,500 and that's a per asset cost, you don't even have to worry about bonus depreciation. You don't have to worry about Section 179. You don't have to worry about regular depreciation. You simply just expense it as an expense. You don't worry at all about depreciation. This is a gift. This is a tool that the IRS gives you, but you have to have a capitalization policy in place. Let's go through a quick example. Let's say that you bought 2 computers for $4,000 total. That's $2,000 per computer. Well, guess what? It qualifies. Even though your total bill was $4,000, each individual computer, 2 computers in there, was $2,000, which is under the $2,500 limit. So that $2,500 is a per item cap. And in that case, 2 computers for $4,000, $2,000 each. If you had a capitalization policy in place, we would never depreciate those at all. We would take a full expense in year 1. That is why I say that every business should have one and should be implementing it. It's easy to set up. You just got to do a couple, dot your I's, cross your T's on a couple different things, and it can be super powerful and save you a ton of time in record keeping. So how do we implement this? How do we put a capitalization policy in place? First, I always say have a written document that you keep on file. Now, this isn't going to be something that you send to the government. It's just something that you keep on file that documents everything that's going on within this capitalization policy. What is your cap limit? Write directly on that document what it is, that $2,500, what qualifies, and when you put it into place, sign it, keep it on your corporate records. Now, one thing to note about a capitalization policy is that you have to use it for all asset purchase. You can't pick and choose. So you can't buy something for $2,000 and say, I'm going to depreciate that, and then buy something else for $2,000 and say, I'm going to just expense it and use a capitalization policy. Once you have a capitalization policy in place, it has to be used for all assets. But again, that's very simple. Under $2,500, expense immediately. Over $2,500, capitalize and depreciate just as you normally would. So step number one to implement a capitalization policy is just have a written document on file that outlines that capitalization policy. And then step number two is make an election on your tax return. It's called a safe harbor expensing election. It's a couple sentences that you add to your tax return that says, yes, I'm taking this safe harbor election. That's it. And then you just need to follow the process for that. Now at TaxHelm, we have sample documents that you can just download, sign, implement all of this so it's easy and smooth and helps you along that process. We have everything to help you with the implementation of that capitalization policy. But again, I'm a strong believer that every single business owner should have a capitalization policy in place in their business so that if you're buying any asset under $2,500, we're not even worrying about capitalizing or what kind of depreciation we don't worry about depreciation. We're just taking that expense in year one. Now, finally, I want to wrap up with this concept of depreciate assets and what happens if I sell a depreciated asset. What happens if I sell an asset that I have on my books? Basically, if you sell a depreciated asset, you may have a gain or even a loss on the sale. And first thing you need to do is find out what your basis is in that asset, which in simple terms would be your purchase price less any depreciation you took. Then your gain and loss would be your sales price minus your basis. So let's go through a quick example to help drive this home and see what it actually means. Let's say you purchase a computer for $4,500. And let's say you took bonus depreciation for that. So you took that full bonus depreciation in year one of $4,500. So your basis in that is zero. You bought it for $4,500. You took $4,500 depreciation. Your basis is $4,500 minus $4,500, $0 basis. Let's say that you sold that asset, that computer, in year three for $2,000. So you bought it for $4,500. Year three, you sold it for $2,000. Again, your basis in that asset is zero. $4,500 purchase price minus $4,500 in depreciation is a zero basis. So your gain is going to be $2,000, which is your sale price minus your basis. 2,000 minus 0 is 2,000. And this gain would be taxable to you. This is what we often refer to as depreciation recapture. So just know that if you sell an asset, and we're taking all this depreciation, if you sell an asset, there is potential for depreciation recapture, and we need to have documentation of that. So we can't just go out and buy a piece of equipment for $100,000, take bonus depreciation, and then sell it in year two and pay no gain on that. Of course, there's going to be a taxable event there if we were to go around and turn around and sell that. So just keep that in mind as you're thinking about this whole concept of depreciation. Remember, depreciation doesn't have to be complex. And honestly, with this one big beautiful bill, 100% bonus depreciation being back, increased Section 179 expense being back, these are all great news, great things for business owners, for real estate investors. We just need to make sure that we're doing it right and understand what options that you have available to you. So, all right, you now have the roadmap. You know why depreciation isn't just accounting jargon. You understand what a capitalization policy can do for you, and you've seen how the rules, especially the 100% bonus depreciation and the boosted Section 179 limits, open up major, immediately deducting potential. That's a huge thing. Most asset purchases, you can deduct 100% in year one based on those one big beautiful bill changes. The next step you need to do is action. Review your asset purchases and ask, can I expense this now? Should I adopt or update a capitalization policy? Talk to your tax advisor about timing, when you acquire, when you place in service, and how your state rules might differ for some of the federal rules. And if you found this helpful, don't forget to hit subscribe. Hit that like button and share it with a business owner who's sick of paying too much in tax. And if you want help from our team of tax professionals implementing capitalization policies, depreciation plans, this along with so many other tax strategies, visit us at TaxHelm. That's TaxElm.com, or click the link in the description for our free discovery call. We are helping people like you legally lower your tax bill every single day. Thanks for coming on, and I'll see you on the next one.